This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covell. Not filtered, raw, honest. That's my passion.
My guest today is somebody who I have been hoping to have on this podcast for a very long time. He has an interesting approach to the markets, best described as a combination of a farmer's common sense and mathematics, while at the same time never losing sight of the underlying fundamentals. You're already thinking, what kind of strategy is that? Guess what? It's trend following. My guest today is Harold DeBoer of TransTrend, a trend following trader with a track record back to the 1980s. A consistent track record every month back to the 1980s. He is one of the legends of the space, legends of the industry. I mean, when you have a track record that goes back that long, it starts to count for something. And now today, at over $4 billion under management, TransTrend is absolutely one of the leaders in the trend following world. And look, one final note, as somebody who has had the chance to live outside of the States, to live in a non-English speaking country, please give me a break today. Give Harold a break today. His mother tongue is not English, but you should listen closely, because anyone with his track record and his experience, if you're not listening closely, there's something wrong with you. Without further delay, without further disclaimer, let me jump right into my conversation today with Harold DeBoer of TransTrend. One of the things that I love about you guys as a writer of books about trend following is the phrasing, the words, the descriptions that you've used for some of your world. And I love this right here. I just want to quote it. I want to read it. Our investment strategies are guided by the footprints left by people running after ideas. That is, the prices they set in the market. It's all just an idea. It has no impact if nobody buys it, nobody uses it, nobody votes for it. But every time people do run after an idea, the world changes. Our world is shaped by people running after ideas. Now, I have to be perfectly honest. I would have loved to stole that line and just pretend it's mine, but I can't because you guys already have it. But that's a great descriptor as somebody who's tried to describe this subject for a long time. Speak to me about that, the notion of the idea. How did that come about?
I wrote these lines when I was asked to explain in short what's really the idea behind what we are doing, behind trend following. And I like to do that in terms that is not too technical. And the fundamental thing behind it is there's a lot of people, economics, who believe in a kind of world turning back to equilibrium. So prices can be temporarily high, but they will come down again. The prices can be temporarily low, but they will come up again. Like there is a kind of reversal to a constant state. But if you look at the world, there has never been a constant state. It's constantly a temporary constant. Look at the big developments we have, like in the Netherlands until 100 years ago, people didn't drive a lot on the roads. Traveling over water was the main way of traveling. So if people invested at those moments would have said, well, now there's roads are coming and people are more and more using horses and carriages and later on cars or even trains, it will come back to the equilibrium of people mostly using boats. That, of course, was wrong. It's a normal development. And these developments, these very big developments, are happening constantly. And that is the main driver why there are trends in markets, because things are really changing. So nowadays, last few years, you see a big move from people driving cars driven by gasoline towards electric cars. This has a big impact because that means that just simple things like in a car which is electric, there's 3 times as much copper as is in another car. And of course, this has a big impact on the market. It means that there's more need for copper than there was before, and there's more need for all kinds of other metals. And this is not something that will revert. It's a new development. It may be in 50 years' time, people are not driving electric cars anymore. We are driving from something completely different. But it's no way that it will turn back to the cars we had 20 years ago. So it's a constant development.
You know what I like about your descriptions, the way you guys describe yourselves, is that unlike some people that you might see in the quote industry, they will talk about the statistics behind something. They will get into the very academic aspects of something. Now, don't get me wrong, you guys have your academic and you have your statistical chops as well, but you guys seem to do a fantastic job of describing what you're doing in the trend following world from a very kind of hands-on approach, a very kind of way that the average guy can approach it. And again, like I said, very sophisticated, statistically based strategies, but from the ground up, philosophically, you're clearly very comfortable explaining things in everyday terms.
Yes, I have to thank my professor for that. Finalized my study mathematics in specialization in statistics. And this statistic professor was really about first knowing what the thing is about and then start to use the mathematics, the statistics, and not the other way around. He was really an old school professor that first had worked in the industry, in his case, not in the financial industry, but other industry, but he first worked in the industry, saw problems there, things that had to be solved, and then recognized what kind of statistics would fit with that. And if that statistics didn't exist already, he would make it. And based on that study, he became doctor. We say in the Netherlands, a doctor in the statistics, and then he became a professor. So first look at the real world, then choose the techniques, and then do it. Then apply the techniques. And what happens a lot is that people start with the techniques instead of start with what things going on with the world. If you look at the world, there's not many markets for which it is reasonable to assume that there is a linear relationship between those markets. Well, if you start your research, what many people do for correlation with all kinds of linear correlation measurements, you have made a mistake already. And you can keep on doing calculations, but the problem is using a linear correlation measurement like that of Pearson's, which is the most used one, already assumes that any relationship will be linear, while there's absolutely no reason to assume that it will be linear. So those fundamental choices are very important. And we often have discussion whether what we are doing is technical analysis or fundamental analysis. But it starts with fundamental analysis, meaning on a fundamental basis, decide which techniques can be used. And only then you can use the technical analysis. And then it becomes pure technical. But it starts with a fundamental basis, which is somewhat opposite to what some other people are doing. You see more traditional finance people kind of turn it around. They kind of start with the technical element and then make a fundamental story, which is just the opposite way.
You mentioned the statistics professor. Let me take you back in time. Before that, I know just a little bit about your early life. I know growing up on a dairy farm. Give me, if you're sitting around with your buddies and friends and they kind of know where you are today, but what's the connective tissue to growing up on a dairy farm? How did that shape you in terms of your world today? Because I'm sure there's some connective tissue there.
Oh, there is a lot, because a cow herd is changing also, and there's a lot of developments in the cow business too. Let's say the Netherlands used to be ahead with the milking cow. The dairy cows in the Netherlands for a long time had been kind of internationally seen as the best cows in the world, which was true until the 50s and maybe till the 60s. And then many countries were importing cows and calves from the Netherlands and crewing them, for instance, in the US. What happened is, while the Dutch were keep on thinking that their cows were the best there is, and they were only looking at all kinds of elements like how do they look like, all kinds of non-relevant issues, the cows in the US and some other countries were being bred in a way that they were producing much better and they were growing such that they would much less diseases. They were much more efficient. And then in the 70s and 80s, the first farmers realized in the Netherlands, hey, we have made a mistake here. My father was among those farmers that started to use the sperm from US bulls again to improve the cow species again. That's something as also a development and such a thing. How do you look at genetics? And behind using genetics is a lot of statistics. So my background in statistics is really coming down and really started with looking at the genes and how that reproduces in cows.
So the real world application right there of your math background is taking place on the family farm.
Yes, I learned statistics from how it happened with cows and calves and collars and all the genes. And then later on school, learned the statistics from the statistic book, and they fit it. But that's the way I learned it.
So basically, for any of the potential competitors, the young guys or young gals that might be listening, you're basically saying, hey, hold on, you might not exactly get the education you need to compete with me at the academic universities. You might need to go to the farm.
Not only the farm, it doesn't even matter where it is. Just look in the world. I grew up a farm, and I was with it in the cows. But if you are, let's say, in a railroad company and you see what happens there, you will see a lot of methylpentates too. So it's everywhere. But start with looking at the world and see what's happening and see what kind of structures are there and what kind of developments are there, and realize that it's developing things. Well, we have the story also on the website that if you take a picture from 50 years ago, you will recognize it's a picture from 50 years ago. And there will never come a time that this picture can be taken again, except for in Hollywood and some other places where they can redo the history again. But apart from that, the world is continuously changing.
As you lay that scenario out, you've got the math background, you're looking at the real world, we've got the farming background, you obviously you start to know about commodities. What's the transition? When is the first time? Because we're talking in the 1980s. When's the first moment that you said to yourself, or how did it happen where, okay, I'm going to go into trading. And not only am I going to go into trading, then there's something, some kind of germ, a light bulb moment where you say, okay, there's this trending behavior that's really interesting to me. Lay that out for me. Lay that story out for me. How did that happen for you?
My professor said that to finish my study, it was best to find somewhere a real life problem. That was in the years that internet was not yet there and email was not there. So I had to write letters to all kinds of firms and ask them if they would have any problem in which would be interesting for someone with a mathematics background to finish a study on. And I got two very interesting possibilities. One was with a dairy factory, and the other one was with this trading firm that traded agricultural commodities. And with my background, I was thinking, okay, later when I grow up, I will be working on a dairy factory. So I keep that one for later when I'm adult. And for now, I will have a look at this trading firm because this is something that I don't know yet anything about and it's good as an experience. So that's why I choose that one. This was a trading firm, traditional agricultural commodity traders. They were transporting them. They were crushing soybeans into soybean oil and soybean meal and so on. So it was really a traditional commodity trading firm. And what they saw is that on the futures markets they used the commodity futures markets, they saw that more and more so-called funds were active there. To their astonishment, those funds never took delivery and never did anything in the market, but still made money. And they said, well, if these people are able to make money in our markets, then we should be able to do that ourselves too, on such a more technical or more quantitative way. And that's where the project started. And I came to that project to finish my study. And it was a very interesting project. And we did all kinds of different things. My first research there was looking at the relationship between meats, so cattle and hogs or feeder cattle. In those days, you still had pork bellies, and not really anymore, but pork bellies also, in combination with the grains and the feeds, so soybean meal, corn, and so on. And there are all kinds of interesting relationship between those markets, and I studied those. And from that, we saw that there would be a way to do some kind of arbitrage type of strategy in those. But looking deeper into the strategy, we realized, okay, it can be very interesting, such a thing, to do that on a more fundamental, semi-fundamental, or semi-technical way. But there's a big risk because if you are wrong, it can be going wrong heavily. And this is, of course, a big disadvantage of all kinds of arbitrage strategies. On the same time, we were doing all kinds of other analysis. We were testing all kinds of strategies that we were being written about and that are traditional technical ways like trend lines and so on. And we were testing other strategies too. And then we found out that trend following type of strategies were very interesting. And one of the reasons they were most interesting for is that other than these arbitrage and more quantitative things, with these trend following way of things, you can trade many, many different markets at the same time. You can really have a large diversification. And where with this arbitrage thing, if you are wrong, the only thing you really can do is make your position larger because you think the markets will come together. The trend following way is just the opposite way around. It's if you are wrong, then you get out of your position, or you even revert, you go the other way. And this way of trend following also much better fitted with the idea that the world is changing again. So all kind of relationships between markets can really fundamentally change. And arbitrage strategy is much more difficult than that. So recently in Europe, we had this issue with a trader in Norway that lost a lot of money by a spread between the German power and Norwegian power. While underlying that thing, there was an arbitrage trader, but underlying there was a fundamental change in Europe, which had to do with the price of emission rights, for instance, and with the change of climate. And such kind of fundamental change really undermines such a strategy, the arbitrage strategy. While in trend following, such a thing is no issue at all. It's a very interesting thing. The emission right trend this year is one of the best trends this year in the markets. So looking at this market and looking at these different philosophies and this different way of treating markets, we found out that trend following is really good. And the best thing about it, that is so great to use in a diversified way. Then we had to solve one issue because the company we worked within had really chosen to only trade commodity markets. You have to realize this idea started just after 1987. 1987 was not really a good year for investing in stocks, to use an understatement. And they decided, whatever we're going to do, we never want to be in financial markets. And then we said, well, with this trend following way, you can also trade all these financial markets and you even get much more diversification. So we had to explain to them why it would be wise to do the same thing in financial markets. That makes us kind of different from many traditional hedge funds, because many hedge funds, they start with financial markets and they have a background in financial markets and sometimes use that without really thinking the same strategies in commodity markets. We have really a background in commodity markets, which gives us a complete different idea about how markets are functioning, and especially when you look at the time structure and old crop and new crop, that kind of things. These things are very relevant for commodity markets. And with that background in commodity markets, we are applying it also in financial markets.
Let me keep you at that point for a moment, because I was thinking, okay, I wanted to ask you about this issue. You start off in the commodity markets. Was there ever a moment for you, given that you had to start in the commodity only markets, did you have the trend following feeling for all markets, or did you start at commodity markets and say, well, we can apply these to other markets? Or did you always know that these techniques could apply to the full global suite of markets out there?
We didn't realize that it could be done for the full markets out there at that moment, because now there are markets that were not out there at that time. So let's say stock indices were pretty new. The stock index futures had really started. 1982 was, I think, the S&P 500 was the first one. So there were not that many stock market futures. And of course, absolutely no sector indices, single stock futures. Those things did not exist at all. But currencies were being traded, bond markets were being traded. So those markets were very good to use these techniques. And later on, we realized that you can do the same thing with sector indices and with single stock futures, but also with emission rights and those kind of new markets that all didn't exist in those years. And I think it's very relevant to keep on being active in new markets, because I remembered in 1998, I think, maybe a little bit before that, we decided that we were wanting to trade the Nasdaq futures. And our, at that moment, largest client said, why would you want to trade such a small market? And we said, well, it may be small at this moment, but maybe it grows. And I think there's absolutely no one nowadays that would call the Nasdaq future a small market. But really, that was a new market at that moment, something new. Can you really trade it? Is it going to last? Well, it is.
And hey, roll forward to modern times, because we're talking about events in the 1980s, the early 1990s. And here we are in 2018. You guys trade, 500 plus markets, yes?
Yes. But that's not relevant. Because, yes, there is 500 plus markets, but at the same time, you have to realize that the real number of different trends going on is smaller than that. So at this moment, you have an energy trend, and you can say, well, we're trading heating oil, and we trade unleaded gasoline, and we trade oil, but look at a day like yesterday, all these markets come down. And that's something you know. The real amount of markets, in the past, we were really saying the more markets, the better. And it still is true, you need diversification, but you also have to realize that the real diversification is not measured by the number of markets, but by the number of really different underlying developments, underlying trends we can be positioned in.
Let me keep you at that word for a moment, trend. There's another great line that I've seen come from your world that I think is great. Price trends are as inherent to markets as the wind is to the atmosphere. I love that one. I love the way of just getting people to think about trends and movements because, when I'm going to go into it in a minute here, I'm going to ask your opinion about factors, and the academic world is trying to find assorted things out there, but again, gets philosophically away from what you've grown up on, from what you guys have done with your firm, is to stay very grounded and say, hey, these big trends exist. They come from sound reasons. We can look at why these things start to happen, but they're unexpected. In fact, you know what? It's probably a great moment to actually jump right into the notion of factors. I find it quite interesting. What is your view of factors? The notion that the academics have said there's a factor for momentum, there's a factor for value, and you can just isolate it and find it in a back test and apply $100 billion to it.
Yes, there are factors, but those are not relevant factors, those ones. The relevant factors are, of course, if OPEC is doing something, that has an impact on oil price and on the price of stocks of all firms and of the price of the Norwegian krone and that kind of thing. OPEC is a factor. A central bank policy is a factor. People thinking about environment and want to pollute, yes, or governments that decide they have to pollute, yes, is a relevant factor. Those are factors. And those academic factors are academic, meaning not part of the real world. And I think when you talk about investing, you should explain, okay, we are buying copper now for this and this reason, and that is not because of momentum or because of value or whatever academic factor. No, you have to realize what is driving copper prices, and are we able to profit from that? And what's driving copper markets? Of course, when many investors are following those factors, then that factor does become a short-term factor. However, will generate a price movement that does not fit with the underlying markets. Because when investors are buying more and more copper for some kind of academic reason, instead of a real life reason, that doesn't mean that ultimately the consumers will use more copper, or the producers will use more copper, or that there will be less production of copper. So the idea why people are buying and selling things, if that doesn't fit with what is happening in the underlying real markets, because ultimately it's all about the real life markets and not about these futures, which should be looking at the real life markets, but not the other way around. When that doesn't work, then but those factors are not relevant. The relevant factors are what's really happening.
Does it kind of make you smile sometimes as a man who's been in the markets trading for 30 plus years, when you see some of this new branding coming around where everyone all of a sudden, and it seems like all of a sudden almost, where factor, and everyone's talking about it. Do you sometimes just sit back and smile to yourself about the branding on Wall Street?
Yeah, but branding, of course, you also have to realize that branding can become by itself a factor, which can really impact markets. Especially nowadays, you really have to understand that the way markets are being driven also is to a large extent by factors that should not really drive markets, but they do so for a short moment of time. And whether you talk about a flash crash, what is really the outcome of people doing something and nothing else than that, or a somewhat longer term disturbance, prices can really go away with a serious force because of money flows, investment flows, that are not driven by what's really happening in the underlying markets. But that force can be very strong. That also means, because now often people say, well, let's say an active investment style, even a fundamental style, should be able to make more money nowadays because of the big amount of passive investors, the large amount of passive investors. But that's not true, because the power of all these passive fund flows is so large that for a fundamental investor, let's say a fundamental or active investor, you have to be able to withstand that force, because this can drive the market for a long time in a wrong direction. Ultimately, it will go in the right direction, but it makes it more harder for active investors. You have reached a point in which there's so many passive investments that are really driving markets that makes the markets more difficult to trade for the active traders, which is a problem, because it means that if the active traders cannot really have a big impact on the markets can really go away in the wrong directions for a short moment of time or for a longer moment of time, which is not really healthy for the economy as a whole.
Do you ever have moments where, as we are talking about assorted factors, and you're laying the foundation for why many fundamental factors are useful to know, useful to understand. But when it comes to your decision making is made off the simple heuristic of price action. Price action is what drives you.
Yes, we have to, because we are not a fundamental trader. So it's not that we say, okay, from a fundamental point of view, the price of cocoa is too low at this moment, so we will buy. No, we will buy if there's an uptrend. But we do realize that there can be a significant uptrend when the market has been too low for a long time, which happened, for instance, earlier this year in the cocoa market. That all has to do with to what extent does the market as a whole still function. Market participants have an important role in that. And if more and more market participants start to behave in a way that does not really match with the underlying markets, they do have a big impact on the market. And that's something we have to take into account. So let's say a Tesla stock, you could say from a fundamental point of view, why is a Tesla stock has been rising so much while the company never made a profit for many years? Well, it's because the thing came in more and more indices, and passive investors have to buy the thing. So because passive investors are buying it, they buy more, it comes in larger indices, it becomes bigger in the index, and passive investors have to buy even more. Ultimately, it's very hard to stop such a thing. Well, this year, finally, Tesla did make a profit, I think, last quarter. But that thing is not driven by really what Tesla is doing, how well they are really doing. The most important driving factor here is getting in more and more indices, and as such, it will keep on growing, which is something you have to take into account. It means that you cannot go short a company or short any other market as long as there is so much power driving it in the other way, even if you fundamentally would say it's being driven in the wrong way. It's good to see why it works. And we very often have positions in which you would say, well, fundamentally it doesn't fit, but there's so much force driving this market on this side, we shouldn't go the other side. We are not the ones that can, the people running after ideas, that's what is happening. Let's say Brexit, for instance. We can say it's a very bad idea for the UK. Well, it doesn't matter whether we think it's a good idea or a bad idea. The thing is, it's happening, so it will impact markets. And we have to take that into account. We will have to take into account that these markets are driven by people running after that idea, that they think is generally happening. If people vote for something because they believe in it, then it doesn't really matter anymore whether the thing that the ones that are, whether it's the president or whether it's a movement like Brexit, it doesn't really matter whether what they say is true. It's all about whether people are running behind it. And when people are running behind it, it will have an impact. It will create trends in markets, but it will have an impact in the world as a whole.
To follow up on your point there about Brexit, yes, you can have a personal opinion about Brexit, but that opinion is not factoring into your decision-making for the funds that you are trading.
No, but it does have a role is when things like this are happening, then we are looking at, okay, what kind of effect this can have and how do our systems work? Is there elements that will not be taken into account by our correlation measures or whatsoever? So is there any place, anything that could happen, the way we work, that's not right for? And it can be very simple things in are we trading the right markets and so on. We have to realize that things are happening, and we have to realize that it can create trends. And we also are evaluating whether what we have been seeing does fit with the underlying idea. So the Brexit election was a very nice case. And in many aspects, what we did was exactly what we expected that we would do and how our systems would respond to such a thing. But there were also a few surprises in there and some elements. If you said, well, okay, this happened now, but next time with election with some strange outcome, unexpected outcome, something like that could happen again, and we could improve our way of handling with these things, for instance, in execution. So we did make some changes on the way we execute orders in very volatile environments after Brexit, and we profited from that when the outcome of the US election when Trump was chosen, because again, then in that night, there was some erratic market moves in all kinds of markets, which we could better profit from because of changes we made after evaluating what happened after Brexit.
Let me keep you in the word trend for a moment. I want to quote from your world. I want to read this. I think it's a great small paragraph. And I'm going to let you explain it even more after I read it, and we can kind of break it apart. But I want to read this. This is great. Trends in particular, those that are most profitable for trend following systems, like those in DTP, your program, are comparable in a number of ways to burning haystacks. Once such a fire is broken out, it's often hard to extinguish. The same applies to price trends. But equally important, a haystack normally does not start to burn all of a sudden. The fire is typically preceded by so-called self-heating, a fermentation process whereby the temperature gradually rises, starting at the core of the haystack, eventually leading to spontaneous combustion. Now, that is another one that I wish I wrote and I could put in my book already. I wish I could steal it from you, but I can't steal it from you because everyone knows it came from you.
Yes, that's really a thing that we worked on when we saw in 2012. In the second quarter of 2012 was a period in which normally you would expect a trend following strategy to do very well. There was a sell-off in especially emerging market equities that then went over to other markets as well. There was typical kind of movement that you would say, okay, a trend following strategy should be doing very well. And we made some money there, but we realized this is not enough. We should have been doing better in this environment. And then we tried to figure out what was happening here, what was going on. Then came this picture, okay, what was different here from previous periods? And that's this combustion thing is happening a lot. The story I think we wrote there is about the Russian situation in 1998 or 1997. The oil price had been going down for a long time for obvious reasons to be found in the oil industry. But for Russia, this was a big problem because Russia was very dependent on oil. So there was a big trend in oil. And because of the trend in oil, Russia came into problems. Until that moment, most investors in Western Europe and in the US and anywhere in the world were not really watching what is happening in Russia. It was not that people in the morning entered Wall Street and were thinking, well, let's first have a look what is happening in Russia before we dare to do any stock trading. That's not the case. No one was really looking at Russia. But then Russia came into a problem and became a crisis. And all of a sudden, this Russian crisis impacted all the market at that moment. That's when we say it's a fire and it is combusting, and then it's impacting many, many other markets, even markets in which it really should not be impacted at all. That's the thing that's going on. And these kind of movements can create big reverses in some trends. US stock markets can suddenly come down too because of a Russian crisis. And as a trend follower, you normally will not profit from being short the US stock market in such a situation, because it was not going on there. Where you can profit from is being at the source of the event. In this case, being short in the oil markets. That was what we were. And this oil market in that situation was at the basis of things that was happening. To make sure that you make money is you have to be sure that you're positioned at the basis where the thing is really happening. For instance, this year in the summer, the Turkish lira had been declining for a long time. And this was a typical Turkish event. It had nothing to do with things happening elsewhere. It was just a local Turkish event. And all of a sudden, one morning at 5:30 our time, I think it was the Financial Times that wrote an article about European banks that would have problems because of these Turkish things. On that moment, there was a sell-off of stock markets worldwide and also of emerging market currencies, above all in South America, for instance. That, of course, had nothing to do with what was happening in Turkey. And the thing in Turkey was going on for a long time already. But just this one thing, this one story, triggered the spreading of this fire to all kinds of other markets. At that moment, we held long positions in the South African rand and were losing on them because all of a sudden the rand was coming down because of Turkey. But to profit from such a thing means you have to be short Turkey because there it was going on already. We had very large short positions in the Turkish lira. That's at the basis, that is where the fire started, where it was going on. That awareness, that's so fundamental, that's so very important, has been the basis for many changes we've been making further on to make sure all kinds of choices you make in the programs have been made such that the chance is large, very likely, that we are sizable positions in any haystack that could become the next haystack causing the big fire. Because we have to be in that haystack and not in the ones that is being infected, because the ones that are being infected, you probably are on the wrong side.
I like how you describe a gradual start of a price increase or decrease, and you describe it as the self-heating. The self-heating is the well-informed insiders making moves. You know, when the average person sees a little bit of an up move or a little bit of a down move, they're not necessarily drawing much conclusion from that. But a price-based approach like you employ does draw a conclusion from that.
Yes, we have to make sure we do, because that's very relevant. And if we don't do, we are on the wrong leg. And when we are on the wrong leg, we are losing money. And it has become more difficult to do this. And this has to do with a broader change in the world. Let's say until 15 years ago or something, all traders didn't know everything about oil, and they were really reading everything about oil and everything was relevant for oil. People trading Canadian bonds knew everything about Canada, Canadian politics, Canadian monetary policies, and for that reason, they were really well informed in that. People trading soybeans knew everything. Let's say our former parent company, they knew everything about soybeans, and they were really not interested in monetary policy in Canada or other things. There's a lot of specialized people, and information was within that group. You still saw it in 2007, 2008. The credit crisis really started in 2007 in the interest rate markets, and it took until 2008 until it really infected the stock markets. Now, information is being spreading via internet and social networks and so on. The effect is that there's much more information available to much more people at the same time. And you would think, okay, if people have more information, they can make better decisions. But people are selecting. And what's happening is that more people are looking at the same thing. So for a short moment of time, earlier this year, many people were only looking at Turkey. It took only a week. In the next period, many people are looking at other things again and forget about the other things. So people trading oil maybe should not look too much at Turkey and should keep on focusing on the things happening in the oil market, because that can be more relevant for the oil markets. If this thing is happening and people are looking at the same things at the same time, this local self-heating will be less visible, because the people that should be trading oil or that should be trading corn or trading corn are not enough looking and watching the factors that are really running the corn market, and instead are too much looking at other factors, which ultimately are not that relevant. And it means that this really relevant factor for the corn markets are not coming into the corn markets until it becomes really a problem. What happened in 2012? All of a sudden, there was a drought, but a drought doesn't start overnight. A drought is slowly growing. It is not that it stops raining and tomorrow you have a drought. It's something that is really developing. And in a well-functioning market, there are enough people, informed people about the corn market, that see there's a drought going on. And as a consequence, the price of corn will rise. If that doesn't happen because people are too much watching the few storylines that are running all the media at that moment, then the corn market is not developing well, and it's harder to recognize the trends. And this is one of the things that makes trend following more difficult the last few years. We have to make all kinds of amendments to make that better again.
As you mentioned, the difficulty from your perspective, and I'm thinking about your short-term perspective, and I'm also thinking about the notion of you don't work under a benchmark pressure, is my understanding. So let's talk about the benchmark part of it for a second, though. How has that unfolded? Now, listening to you for 45 minutes, I can see there's a very sound philosophy from the ground up. You've got a perspective, but hey, investors are often irrational. I'm assuming you've probably trained your investors very well. And of course, you've had performance for a long time. So that helps a lot. But speak to the idea of benchmarks and how you have allowed yourself, your firm, to steer clear of benchmarks, because benchmarks psychologically can really cause harm, can't they?
We, of course, as CTAs, we have much less problems with benchmarks than traditional stock investors that really are trying to stay close to a benchmark and then will trade the markets because of that. But it also had, I would say, a negative impact. Let's say in the 80s, there were some CTAs, especially some US CTAs, that were very successful, but they were not really recognized in the broader investment community. Institutional investors and so on would not invest with CTAs. Coming into the 90s and especially the early 2000s, when we had some stock market sell-offs, institutional investors realized that trend following strategies could be okay. And then what kind of happened is that trend following was started to be seen as an investment style. Instead of many different traders that do similar kind of things and all of them doing well, it became a kind of the style. Instead of people deciding to invest with John Henry or Campbell, to name some of the older names, investors decided to invest in trend following and then had to find which name to invest in. That didn't make things ultimately really better, because the essence is that there is difference between those investment managers. And it's really important that investors realize the differences, because And trend following style is not just doing the thing and do exactly the same thing. The trend following style has become successful in many years for the 80s and 90s, amongst other because all these investment managers were doing maybe similar things, but also a lot of different things. And their difference, their variation, made them strong together, which is generally true in nature. If you have, let's say, dogs too much look like each other, the species isn't very healthy anymore. Well, that also happened in the CTA industry, in which it became very important to be aware that you constantly have to make the decision which is the best decision from your point of view, instead of being some kind of pulled into an investor demand of doing exactly what people think that trend followers are supposed to do. We did not become a success because we did what we were supposed to do. We were successful because we did what we think was the best thing to do. And if I go way back in history, when we did the first studies on trend following, we found an article that says there was 3 things very important in trend following. One is you should always be in the market. Second thing is you should always trade at the same size. And the third thing was you should always use stops. And when we did our trend research, we found out that trend following was really great, but you should not always be in the market. You should not always trade the same size, and you should never use stops. So we accepted everything except for the 3 being recognized as the basis things. And we once were, those years, at a conference with investors. It happened in Italy, and I was there with one of my colleagues. And we were walking to the lunch, and there was some potential investors walking in front of us. They were talking to each other and said, those people behind us, they are from Transcend. They are good. Yes, the other one said, they are good. But then the other one said, yes, but they don't use stops. That's bad. Yes, that's bad. And that was good because those investors didn't decide to invest in us because we didn't use stops. We said stops is a bad thing to use. And in the last years, when, let's say, trend following kind of becomes a style in which there's a lot of stories about what trend followers are supposed to do and what they are not supposed to do. And you also see this with these independent advisors that are also then do box ticking. Are you doing this? Are you doing this? Are you doing this? It kind of drives investment managers to do things that are not really the best things to do. So it's a decision to say we don't use stops. Yeah, if you being selected based on a box tick that says trend following CTA has to use stops. They don't use stops, okay, we will not invest with them. That's a bad thing. It became unhealthy. The last few years, I see some developments in making different CTAs more different choices again. And I think that's very important. CTAs have to explain what they're doing. And there should never be a list that says this is what trend followers should be doing, because there's nothing that trend followers should be doing. They should be studying the market and do the best to make money. But there's no rule like they should be using stops, or they should be using crossover strategy, or they should be using momentum, or they should be using a value at risk measure that is defined such and such way. Absolutely not.
So you guys are systematic. Have you always been systematic? Going back to late 80s?
Yeah, so the research project when we did, some of the things were based on more fundamental strategies. And we founded our research by doing fundamentally based trades. So the first trades we did in the markets were really sizable trades. But nowadays, you would call them macro trades in commodity markets. So we were trading. My first research was about developing of hogs and how they responded to a drought. In 1998, there had been a drought. What impact does this have on the amount of pigs and the amount of corn? And what kind of price move then can you expect? And because of that, we decided to take a big long position in hogs and make $1 million with that. And from that, we could do our research for a long time again. That was the way we started. But we did so to finance, the right word here, yeah, to finance our research. And the research ended up into doing everything systematic. But always keep in mind the background underlying market.
I think it's a good point that I'm bringing up to buttress everything you've said, because you lay this foundation of knowing how things work to then use those real life factors to apply a trend following approach. But I think somebody listening, not knowing that you're systematic, then that throws another wrinkle into it too, that yes, you can be a very opinionated man, you can have these very strong views, but at the end of the day, your system is written down, it's coded, and you're executing in a systematic fashion.
Indeed. And this is very important nowadays in the position, because we want to make very clear, look, what we are doing is not because we read about some rules and apply them. No, what we are doing, we are watching markets, studying markets, and based on that study, we choose techniques and we systematically apply those techniques. And that's different from we start with techniques. No, we start with watching the markets, developing techniques, and apply these techniques in a systematic way.
Everything we're talking about in this conversation, all the academics, I mean, I guess there's been some change in the last handful of years, but for the longest time, you could see the academic papers, you could see the Nobel Prize winners. They were telling you for the longest time, Harold, markets are efficient and you can't be doing what you're doing. It doesn't work. It doesn't work. And here you are for 30 plus years, just kind of scratching your head. I seriously doubt you're scratching your head. You've probably been very happy with the direction you've gone, but it's got to be interesting to watch this community of folks across academia and Wall Street talking about efficient markets over the course of your career.
The academics now have turned into a complete different direction. I wouldn't even want to call them academics anymore, many of them. Look at the amount of articles that is being published now that are really nothing more than backtest results. If you did such a thing in, let's say, 20 years ago, and you wanted to publish something like that, all these articles you can read, there was a discussion about whether you had to take into account 1% price impact or 1.5% price impact. That was what the discussion was about. And the outcome always was, okay, it may seem like you can make money, but if you take the cost into account, the market impact into account, there will be no result. Nowadays, 10 years or something, it happens more and more. You see articles being published which assume no market impact. And the story there is, well, markets are efficient, and the liquidity is very large, and because the liquidity is large, you don't have to take into account any market impact. I don't see the academic thing behind that, because then I want to hear an academic story that explains me how then do markets move and how then do prices move when it is not because of due to impact of people trading these markets. I can't find reasoning, because market impact is the only thing that moves markets. And that's the role of investors, is to be aware of that and to be aware that they have market impact and that they are the ones that are making the market. They're not the ones that can make profit out of the markets and the markets themselves will automatically go in a certain way. No, all the market participants are making the market. They make the market go in a certain direction, and all movement is market impact. So these academics that kind of say, well, look, it happens automatically and you can just do this and this and you just apply it and this will come out. That doesn't function. It doesn't function because it neglects, it denies the element that markets are being moved by what people are doing in the market. Look at a stock like Apple. People may think that the price of Apple stock rises when many people are buying their iPhones. But that's not what is happening. They can sell lots and lots of iPhones, but if no one buys the stock will not rise. The stock only rises because people are buying the stock and are willing to pay more for the stock than they were willing to pay before. And we all hope that people do so because they expect that Apple will sell a lot of iPhones. But if they forgot that element, then the price will not move at all, or the price will move in another direction than what the ultimate results of the company Apple is. So it's all about market impact. Market impact is the only thing that moves markets. And to us, as an investment community, we have to take that into account. And we have to be aware that we should never neglect the underlying market.
It's got to be comfortable is not the word, but given the longevity that you've been in the trend following space, to have a foundation, to have a real world record that people can look to. I mean, of course, the past is the past and we don't know what's going to happen in the future, but we can draw a little bit of inference from a long track record. It's got to be interesting to some degree to see so many academic folks, and I'm not saying they're bad people or anything like that, not saying they're not smart, but quite a few academics have gone straight into fund management with all of these papers and have raised a lot of assets on techniques that might not be the best thing in the future.
Oh, no. I recently gave a presentation about responsible investing in commodities. There is a lot of investment managers that are offering long-only positions in commodity futures. And some of them present all kinds of semi-academical stories behind why being long in a commodity future would give you some kind of risk premium. These stories are just completely wrong. And they can prove wrong. If you just look what happened if you would have been long wheat from 1970 onwards and keep on rolling. It's not rolling cost that people can say, well, it's because of the rolling returns you're losing. No, it's not. From day to day, there's a risk premium normally being paid by the ones that are long and not by the ones that are short. And there's a fundamental reason for that. So all these semi-academical stories that say, well, you can invest long only in commodities and you can do like this and you will get a risk premium, and often they address to Keynes. There's one basic rule for anyone that wants to invest in commodities. If some investment manager visits you and tells you why his strategy works and he refers to Keynes, you can be sure that 1, he did not read Keynes. 2, if he did read Keynes, he did not understand it. And 3, he does absolutely not what Keynes was referring to. So such an investment manager will surely not make any money on that strategy. So the best way to recognize a bad investment manager in commodity markets is someone that refers to Keynes. The best one I once saw was an investment manager that was telling about referring to Keynes' cost of carry model. Maybe you know the model, but the idea is the cost of carry model is based on the idea that you have a commodity, you can store it and then sell it at a later moment, and the price between the futures now and the futures in the future is the cost of carry, the amount of money it costs to store that commodity. And I saw an investment manager that gave a story about it with reference to feeder cattle. Well, feeder cattle has to be alive, and I think out of my head between 3 months and 6 months in age. And I don't think there's any way you can store living cattle, calves, between 3 months and 6 months in age for a year. And in a year time, they're still between 3 months and 6 months in age. I don't think the cost of storage will be extremely high to make that happen. There are some people that would like that they could get 1 year older without getting older, but it's completely impossible. And using these kinds of theories and apply them to things that they are absolutely not connected to, it's bad academics.
Do you perceive any advantage over the course of your career where you have been based? In Rotterdam, in the Netherlands, being Dutch, has this been an advantage to you from your perspective?
Sometimes it has, sometimes it has not. Let's say for potential investors, we are farther away. And what often happens is that potential investors are, let's say they are visiting London and they can then visit many investment managers in a few days' time. They visit 5 in a day and then make a trip and they visit 15 investment managers. And of course, they will not visit us in the Netherlands or our colleagues in Sweden or our colleagues in Paris because they are further away. The advantage of that is that the ones that do visit us are more serious. So that means the amount of time we spend with talking potential investors is smaller than others because we don't have these ones that are not really serious. There's one advantage or disadvantage, just how you want to name it. Another difference is with the staff we have. We are not competing with people that can choose for another firm that is around the corner. The people that work here, they have chosen to do this, and the alternative is to do something completely different. Most of them would not even be working in the financial sector. This is an advantage too. So the students from this region in the Netherlands, in generally, if they want to do work for a CTA or a hedge fund, they have not that much choice. That's an advantage. And another thing is, which helps, is because we have different people than other CTAs, we also are better in having our own ideas. In London, you see a lot of people that have been working for one CTA and then they work for another one and then work for another one. So what often happens is that you see similar ideas with different CTAs. Because we are somewhat more isolated, we are, let's say more like the people on the islands in the Atlantic Ocean, still ocean. What do you say? The Pacific, I think it is called. The Pacific. There's the small islands and people are living there completely their own way and have colored faces and so on. Well, we are a little bit like that.
You don't want to be tainted by all kinds of bad influences.
No, it's not even that we don't want, but no, it's the being different and another place helps you to be yourself.
No, it's great insights. I appreciate you giving my audience a perspective. Perhaps we can grab a conversation in the years to come again. I really enjoy the perspective. And again, I'm very jealous at many of the perspectives that you guys have written about because I just want to, I just want to steal the quotes and put them into a book, but I can't now because everyone knows who wrote them, so I can't steal them. So, but listen, great stuff. Hey, and the best place for everybody to go and check you and your firm out is transtrend.com, correct?
Yes. And look at the philosophy page because that's where it all starts from.
I mean, look, I've had a chance to speak to so many peers of yours. Probably we have mutual friends that we don't know about. And one day I'm going to have to make it to Rotterdam. We'll have to do lunch. It's been a long time since I've even been in Amsterdam. It's been over 20 years. We'll have to grab a lunch one day. I appreciate you coming on today.
Be aware, Amsterdam and Rotterdam are no friends.
They're not friends.
No.
You want nothing to do with them. You've drawn the line at Rotterdam. They're not allowed over.
In football competition, when Amsterdam plays Rotterdam, the public from Amsterdam is not even allowed to visit Rotterdam.
Speaking of that, if we get a second conversation in the future, I would love to talk to you about your speed skating story. Fascinating.
Okay.
Yeah. So listen, Harold, I appreciate you taking the time today.
Okay, thank you.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.